Hey guys, the Swing Trading Club here. A lot of activity coming out of the markets this week. We had a pretty big uptick. Now I'm going to get into the reasons why I think this is what investors call a dead cat bounce. We're going to get into what that means here in a second, go through some economic reports, and then what to look for in the coming week. So stick with us. So to lay the groundwork, I want to quickly go through some of these recent news releases slash economic reports that came out this week. The first one is going to be unemployment insurance weekly claims. This is just essentially saying, how many people are filing for unemployment insurance, meaning, I lost my job, I need to get insured, etc., etc. So there's a whole kind of report dedicated to this. But really what I want to focus on is just this bottom portion here, and bear with me as we kind of slide down. And what this is looking at is states with an increase of more than 1,000. So this is pretty micro based, really. Only we're in the low thousands here, looking at these changes. But I want to show all these layoffs, especially in manufacturing. Layoffs in manufacturing in Illinois, manufacturing, transportation, and warehousing. So that's going to tie into our next PMI print, but I did want to kind of set the stage here. And this is a good report for you guys to always check in on and just kind of see where we are. And let's go over to quickly view the Fred view, and just kind of see where we are for historical context. Now, of course, this was super high during the pandemic. Obviously, there was a lot of job losses, so this claim was through the roof in 2020. Once we started getting kind of post-pandemic, right, and we zoom in, you saw a steady decline. But we really bottomed out here kind of in the last couple months, and we started ticking up, progressively since about March. So that's just something to keep an eye on. I'm going to zoom in one more and just kind of see if we can really hone in. Yeah, so at the end of March, you saw the lowest, and then we've been at a steady increase since then. So just something to pay attention to, guys. So why that weekly index is important to look at, because it kind of lays the groundwork for something like PMI, which also came out this week. Now this is something that a lot of people pay attention to. Not so much on Wall Street because they're a little bit more day-to-day, but a lot of the kind of more macro folks are really honed in on this. It's kind of like the smart money of business, if you will, in terms of where directionally we're headed. So you see the last key findings. This was released on the 23rd of June. So we're seeing 5-month low, 5-month low, 24-month low. And PMI stands for Purchasing Managers Index. It's essentially saying, where the state of businesses are in America, right? Now, there's also UK. I think this specific report is just for US, but you can also find what it looks like in the UK as well. But really for this one, you just kind of want to pay attention to the general trend. If we kind of zoom in over here on the right side of my screen, you can really see this sort of drawdown coming from the highs, kind of post-pandemic, and really drawing back down to that line. So we want to be careful and just kind of keep this in our data points of how we view the overall market and what sort of headwinds we're seeing. Because with this print, it's pretty strange that the equity markets did what they did this week, and we'll talk all about that. But just I kind of wanted to lay the groundwork again here. So a little post edit here, guys. I wanted to quickly explain exactly what this is, just because I gave a high-level overview of the numerical values, but I didn't necessarily get into the actual figures and what they represent. So what this is it's saying what businesses are actually buying, selling, putting out into the market per se, right? So you can kind of think of businesses, this is like a bellwether for where the economy might be headed. Consumers are very kind of day-to-day, and there's a lot of volatility in consumer spending, saving, etc. But this one tends to be kind of a canary in the coal mine, if you will, and really something that you want to pay attention to. So I want to grab just a few kind of quotes from this, and we can just kind of highlight this, and then we'll move on. So weaker growth in businesses activity was driven by a solid fall in new orders. So again, guys, these are new orders that businesses are buying. Client demand dropped for the first time since July 2020. So this is, we're seeing a big decline coming out of, or a big uptick coming out of the pandemic, and now we're starting to see that decline. Another quick kind of headline I want to read from this. Slowdown in operating conditions and overall upturn was the weakest for almost 2 years as contractions in output and new orders weighed on the headline figure, right? And then finally, I'm not going to read this whole thing, but over here on the right side of my screen, the pace of the U.S. economic growth has slowed sharply in June, with deteriorating forward-looking indicators setting the scene for an economic contraction in the third quarter, right? So this is kind of a bellwether that we need to pay attention to, and a lot of folks, like I said, on Wall Street, they're a lot more day-to-day and just kind of go with the latest momentum. But looking at these reports give us a good insight to where the economy is headed in general. So I just kind of wanted to make sure that point was articulated a little bit more clearly. I'm only going to spend a few seconds on this one. We talked about this last week, but labor force participation rate, I do want to just keep noting, this is starting to generally trend upwards, which is, kind of depending on what side of the aisle you're on, is how you want to look at this. It's saying, hey, we have a really strong economy, more people are participating, et cetera, et cetera. And now on the other side is saying, hey, nobody has any money, so they have to go back to work. But regardless, this has been dropping pretty steadily. And really, to put a little bit of historical context in, back before the financial crisis in 2008, we were like 66, 67. Now we're still here at 62. So we have a long way to go to catch up back to those levels. But just kind of wanted to set some context for you guys on that one. Now, one of the last, it's not necessarily a report, but just something to keep in our, kind of on our table for analysis, is what we call home price to median household income ratio. So it's essentially saying, what are homes priced versus what are people making? And so you see the housing bubble, this ratio is about 7. Now it's a little bit closer to 8. So, not an economic report per se, but just something that I like to pay attention to. And I know in previous videos we talked through what the real estate market looks like currently and why I think it's going to, really extend this bear market / recession, because we really haven't seen prices come down across the board. We've seen it in, little subset, areas, but not to the extent of a full-blown 2008. So just keep this in mind, and I think it's important to look at for historical context of kind of where we are. This is actually a pretty cool website. They also have some information on, the UK as well to kind of see where they are. But pretty similar to us, the housing bubble, they're up at 9% or 9, the ratio. So I'll put this in the show notes, but just for some context here as well. Now I want to move to our friends at the Fed and kind of talk through Jerome Powell's latest update and exactly where we are in the labor market, because remember there's this kind of dual mandate that the Fed has, right? It's one, to control interest rates, and 2 is to control the labor market, right? Now, control might not be the best word, but that's their mandate that they've been set. So I just want to quickly talk through what we're seeing here in the labor market. We saw a little bit of a downtrend, so we're going to, I'd imagine, keep seeing this fall and fall, right? We're seeing layoffs across the board. You're starting to see this downtick here. This guy right here, just so everybody's aware. I'd imagine this is going to keep falling. So that's kind of what the Fed wants. You can't fight inflation without a labor market, not really a sell-off, but more of a drawdown, right? So keep this in mind. We're starting to see the very beginning innings of a turnaround in the labor market. This is just job openings in general. So keep that in mind. Again, I'll put this in the show notes for you guys to check out, but monitor that. And this is actually a report that came out, I think maybe over the weekend, and this was from a Cleveland, the Federal Reserve Bank of Cleveland, excuse me. And I really kind of quickly wanted, before we hop into this, just to show you, not everybody's familiar with how the Fed actually operates, but there's 12 districts, and they each kind of control their little precinct, if you will. But this one specifically is in Cleveland, right? So just kind of to set the stage, there's one kind of Fed that's, overarching, kind of like an umbrella, and then there to have all these different districts. So that's kind of how you can think through it. But regardless, I wanted to show you that this report coming out of Cleveland is kind of eye-opening what they're actually looking for. So they're expecting a CPI print of 10.03, right? The last one that we had, I think was 8.67 or something, right? Year over year. They're expecting a pretty large increase. Now this is quarterly annualized percentage changes, but they're saying this is not going away anytime soon. And so let's just keep that in mind as we go through that. We talked extensively last week about the Fed raising interest rates 75 bips and what that means for the market. And a lot of, at least the bond market right now is pricing in another 75% rate hike, or not 75 bip rate hike. And so monitor what these expectations are and how they change day to day, because when you have something like this coming out, I think either Friday or Saturday, that can change expectations and you can have a pretty large sell-off occur. But again, this is just one district and we're not 100% sure what this is going to look like, but I would be, if I was a betting man, I would say that CPI is not going to peak just at that 8.6% level. So keep that in mind. And then finally, just to see exactly where people think we are. Now, this isn't, this is just kind of the Hill that is reporting on this. And so we're not going to get into exactly what, if we wanted, we could kind of hop into this poll, but it's just a bunch of, kind of numbers there. But the headline, 56% in new poll believes U.S. is in a recession. So this is just, those kind of polling data that you get all the time. But it's saying that the majority of folks already think we're in a recession. So expectations are really beginning to shift here. So just keep that in mind as we go forward. Let's pause it. Now, I also wanted to point to copper. Copper prices, this is just one of those macro trends kind of websites that tracks these different commodities, and metals, precious metals in this case. But I quickly wanted to just show you exactly what we're looking at here. So we had a pretty stark sell-off. Now, a lot of investors use copper as kind of like a bellwether, and this is just coming from a report on June 24th. I actually didn't know this happened. This is kind of a recent sell-off that's been happening in June, but it's good for us to kind of keep an eye on all these different things, just like the PMI, just like some of our other sort of reports that we're looking at. Copper is another one to kind of keep on our table of data and think where we're headed and what kind of economic conditions could be around the corner. Now, the reason copper sells off is simply because a lot of manufacturing, especially in buildings and stuff like that, involves copper pipes. So when you see a sell-off, like you did during the coronavirus down here, it's essentially saying, okay, we don't think there's going to be a lot of economic activity, especially in the buildings and stuff like that, that it's going to start selling off. So just keep that in mind and see where we end up going with that. But it's definitely something to pay attention to. Now, the final item that I wanted to talk about here before hopping back into our Webull for a little bit of more market kind of movement. Biden is going to Europe this week. Well, I guess he's already in Europe, I should say. But just keep an eye on this, guys. I'm not going to get any sort of political commentary around this, but just understand where we are in terms of the length of potential conflict in Russia and Ukraine, and kind of what this means overall for for supply chains, and kind of what we're seeing here. So One thing to note, and again, not being political or anything here, but just looking at the USD to RUB, this is just a Russian ruble. When this invasion of Ukraine originally occurred back in March, you saw this huge spike. So what this chart is saying is, historically, for every $1, you're going to get, about 73 to 74, 75 range for Russian rubles, right? And then it shot up. So for $1, you're at the peak of, the Ukraine invasion, you were able to get 132, 133, 135 even. So what this is saying specifically is that our dollar is stronger than the Russian ruble. And because there's all these sanctions and because, the world is essentially coming together to dispel Russia and, chastise them for the invasion, nobody's going to want to trade in rubles, and we're going to essentially cut them out of the market. So, that currency, in order to sell it, you're going to have to, trade it at a discount. Now, something very curious has happened since then. So, remember this level about 73, 75? Well, you can clearly see here how strong the Russian ruble has now become. And this is kind of backfired again. I'm not going to get political or anything like that, but we were about a mean of 74, 75, and now it's about 55, 56. So just keep that in mind. Where this potential conflict might end in terms of territory lost or gained by the Russians and how long this might actually last. And this is just a CNBC headline here. It's at its strongest level in 7 years, despite massive sanctions. Here's why. I'm not going to go into that, but just kind of think through this kind of market dynamic and what it looks like for the type of headwinds we might be facing. For instance, supply chains, just dollar value, et cetera, et cetera. So keep all that in mind, and we are going to jump back into Webull. All right, now to the fun part, everyone. So let's take a look first at just the kind of insanity that we saw this week. And this is just a out-zoomed picture of Ark Innovation, obviously the one that Kathy Wood runs. And I wanted to show you just quickly what kind of support that we're seeing here. And we had a massive uptick this week. Or I shouldn't say massive, I think they're up like 14%, but still pretty large for movements in the bear market. Now, I wanted to just show you what sort of these bounces are, right? We see a lot of times, and I'm just going to draw here, bounce, bounce, mini bounce, 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 right? When we're headed into these bear market, there's always going to be these corrections, guys. So I would not be trading this if it was the last thing on earth to trade. Well, I don't know about that, but just be very cautious of, look at these downtrends. Look at our moving averages. Everything is still headed straight down. And for me, as a swing trader and just a, trader in general, I don't want to try to time this bottom. That's not something I want to try to do. If you try to buy at every little turnaround, you're probably going to get hit pretty hard. What I would do if this is a long-term investment for you, dollar cost average into something like this, but I would not be a buyer right now, and I am not a buyer. I still think there's a lot of pain that needs to get worked out of the system, because right now with a lot of these high-flying tech companies, we're essentially to where we started before 2019. But again, remember, it's really since 2008, we've had massive monetary policy in the form of quantitative easing that's been pumping money into the system like crazy. So we're not really too sure what this is going to look like in a quantitative tightening world. So I would just be really cautious of this and not be jumping in. And something like Tesla too, right? You kind of saw this big bounce. I think they were up like 25% this week. But just be mindful of hopping into any of these type of plays, because they can really kind of rip your face off if you're not careful. And this is, very, very common in bear markets, that you see these huge rallies in these kind of what you call risk-on assets, right? Everybody's risk-on, gold is down, these tech companies are ripping. That's something very akin to what we saw in 2001 with the tech bubble. So just be very mindful of that, guys. And now we are looking at Nasdaq. I wanted to go back to 2001, 2000 type of time frame for a little bit of more historical context. I know I've brought this chart up multiple times, but just for any new listeners, I just want to keep going through because it's so important that we see all these kind of local tops, right? All these little, what you call dead cat bounces, all these until it really starts kind of turning around. And this has been a long turnaround, guys. You know, this is, I think, 900 trading days. I think we're only about 180, 190 mark, maybe 200 of this current downturn. So let's just be really mindful of kind of how long these bear markets can last and what the conditions that we're going to need to see to really understand that, hey, we're not in a bear market anymore. And what you want to look for, guys, is really these moving averages. Once these start turning around, see how this started turning around about May, June of 2003? You know, you got a crossover here. That's a big indicator. That's when I'm comfortable in starting to call this a bottom, right? Here, you know, you're going to leave a little bit off the table. Nobody's going to time the bottom. It's going to be very difficult. And even if you did, you're only gaining another, 5-10% on your investment, right? So let's be really sure that we're actually going to be seeing a shift here, guys. And this is where moving averages, that's why I like to play these so much. So just keep that in mind. So now we're looking at LLY. This is just a trade that you might remember from a few weeks ago. Always love patting ourselves on the back when we actually get one right. Now from this one, we saw it kind of bouncing off the 180-day moving average and start trading up back into ranges that we thought were acceptable. Now notice where we put this entry price at. It wasn't down here. It wasn't at this kind of low point. It was actually right after we broke the 100-day and right before the 50-day. So that's kind of what we were aiming for in this trade, and actually ended up working quite nice for our members. So hopefully everyone took advantage of that. So the ones on my watch list, at least that we're giving away for free, again, premium members have access to about 10 to 15 picks every week as a free subscriber, which is totally fine. We're only offering 2. So if you are interested in those additional picks, definitely join the club and talk to me if you do have any questions prior to joining. So hopping into WLL, we're really hoping we see a kind of mean reversion. Now we traded straight through all our moving averages, which is never a good sign, but we have kind of met this level of resistance down here, right? Or I should say support, excuse me. So we kind of met this level. We're going to see where we trade from here. I'm hoping, obviously, we go up here, but that's always easier said than done. But we had a pretty strong sell-off. If you look over my 5-minute chart on the right-hand side of my screen, I'll make that a little bit bigger for you guys. But we saw a large sell-off to close the week. Now, I'm guessing we're going to have kind of an uptick on Monday, but that's yet to be seen. Now, what kind of stock is this? This is a petroleum, natural gas, oil type of stock, right? So it plays in that sector. It's the energy. So if you think oil and energy and commodities in general have more to run, and we're not just going to keep falling, then this is going to be a stock that you're going to want to be in, at least for a quick trade. I'm part of that camp. I think that we still have a lot more pain to go through, especially in the oil market. I just don't think the supply and demand dynamics are, kind of ironed out yet. There's a lot of dynamics there that have a while to work out, and I actually think I'm going to be making a video in the next couple weeks really diving into that. But regardless, I think there's still more to run. I think we found a level of support here. Let's flip over to the 2-hour. Consolidating a little bit, right? But let's see how this one opens on Monday. If we start really running back, I can see making an early play on this and trying to close this out after a week or so. So let's be mindful here, see if we can catch one. Our next free pick of the week is CHS. It's actually I believe it's a woman's retailer. So this one is more so just for kind of technical purposes versus like, large macro events like energy and stuff. We saw a crossover of the 50 over the 100 and 210, and so this is a good sign that we're starting to see a little bit of a turnaround here. It's coming off a support level down at 3.84ish and hoping to catch a bid on our way up. This is one that is going to be kind of a green light, red light for me. If we start seeing a good open to the week, I can probably see this one going, high fives, low sixes. But I'm keeping my stop loss very tight on this. It's a pretty volatile stock. But it might be a good one if we're able to kind of catch this recent trend. So watch your 5 and 9 day moving averages. Look at these short-term kind of time frames, right? And see where we end up opening up on Monday and how we might be able to trade that. So that is it for this week's video, guys. Next week is the 4th of July. I think I'm going to be posting a video kind of about more of my long-term plays and a little bit, maybe a deeper dive onto the supply and demand of oil and kind of what I'm seeing on that front. But regardless, go give us a like, subscribe. Not really too into that kind of stuff, but it certainly helps out, I suppose. Definitely visit our website. Put a lot of work into this, and it was a little bit of a kind of passion project of mine over the last couple of months. So would appreciate if everybody at least goes and checks it out. Definitely let me know if there's any questions, and do sign up for our premium membership if you're interested in joining our Discord group chat and access to my weekly watch list, 10 to 15 picks every week. And we do have discount codes available, so reach out and see you guys next time. Thanks a lot.